Hello friends. Last week we saw the markets edge higher, but it was a slightly lopsided market. The Nifty went up, the Bank Nifty dragged. Now the question on everybody's mind is, will the Nifty test 20,000 levels in the coming week? In this video, I want to answer that question specifically, of course, based on data. So let's dive right in, and on your screen right now is the market roundup window, which tells you that that rally was powered by the Nifty itself. It is broader based, whereas the Bank Nifty lagged. The US dollar index fell 231 basis points. Now that's a big sharp decline. That is one reason why emerging markets including India rallied forward. And a falling dollar as usual impacted commodity prices bullishly. Gold went up a little under 1%, silver shot up 6.5%, and crude oil went up by 2.22%. A little bit of help came from the Russians announcing voluntary output cuts. What we saw was natural gas come down a little over 2%. The USD INR, which is the dollar versus the Indian rupee, came down by 59 basis points, which means the rupee gained a little bit of strength, and the 10-year benchmark bond yield fell by 8 basis points to 7.08, which means bond prices went up. That cushioned the declines on the Bank Nifty. The NSE market capitalization went up by 0.2%, which tells you that the rally was somewhat broad-based, and all three US indices gained on a weekly basis, and that provided tailwinds to the Indian markets. Friends, I now come to our in-house indicators, wherein we first take a look at the MWPL, which is the market-wide position limits. Now, these are exposure limits utilized by traders as a component of the total allowed by the Securities and Exchange Board of India. We are now at 35.93% in the second full week after expiry. Now that is very simply the highest in the last 4-month period, in the 4 derivative series that we cover in this weekly chart. And that tells you that risk appetite continued to grow. And as long as risk appetite is growing, what we are basically seeing is that bulls and bears are both taking bigger exposure, and one of them will ultimately have to surrender, which will lead to high volatility, because whichever side surrenders, the market will move to favor the dominant party in a big exaggerated price move manner. I now come to the index and stock futures turnover. This is basically concurrent of 3 series, which is July, August, and September. The turnover for index futures went up a little more than the turnover for stock futures. Do remember that the week was somewhat cautious because of the underperformance by the Bank Nifty. But one marshmallow participation still remained fairly okay. The market was fairly liquid. I now come to the advanced decline ratio, and this basically tells you that the number of shares advancing versus the number of shares declining. And after the price itself, this is the most leading indicator of which way the winds are blowing. Now, the Nifty gained 1.20% on a week-on-week basis, but the advanced decline ratio fell from 1.17 to 1.11. Which very simply tells you that for every 100 losers, there were 111 gainers. So even though the bias is towards the buyers, the conviction level was somewhat lower, because in the prior week, for every 100 sellers, there were 117 buyers. So it's a little bit of a decline, but as long as this ratio remains above 1.0 and rising with the price, I think bulls are still in charge. I come to the basis The basis is nothing but the futures premium or discount to spot. As long as risk appetite is high, the basis will also remain high. And if basis is falling, there are two reasons. Number one, as expiry approaches closer, the basis falls just like options premium, and it could also be an indication of selling at higher levels. So basis on both the indices fell, both on the Nifty and the Bank Nifty fell. And the Nifty's basis in percentage terms actually fell sharply. That means at higher levels, two marshmallow traders have unwound long positions and there is little bit of a jitteriness thanks to the Bank Nifty primarily. As long as the basis remains above zero, the bulls still have a chance. Friends, I now come to our in-house indicator, the impetus which you've been trusting and trading on the back of for 2 years now. Now, last week itself, I pointed out to you how both the indices had logged a variance in their impetus. The Nifty impetus had hit a period high in the chart last week, and it tapered off slightly as I had expected. I had told you that such a sharp rise in impetus was unsustainable and a little bit of a cooling off was expected. So there you have, the Nifty impetus has cooled down. I would not rule out further cooling down in such high readings of impetus in the Nifty. The Bank Nifty impetus actually fell. Not surprising, because the Bank Nifty itself has logged mild losses of 0.24% on a week-on-week basis. So what we are seeing is something that I have been pointing out to you in my live mint columns, weekly columns, as well as my videos. Now you see, I feel the market is like a bicycle with the Nifty and the Bank Nifty being the two wheels. You cannot have the front wheel going forward and the rear wheel going backwards. The bicycle will fall. So for the market to go up sustainably, the impetus and the price of both the indices should be going in the same direction. So can the Nifty reach 19,000? Hey, much will depend on banking stocks. Do remember, banking and financial sector services constitute 1/3 of the weightage of the Nifty itself. Friends, I now come to the second exclusive in-house indicator that you've been trusting for over a year now. As with the impetus, this LWTD or Lift Weight Thrust Drag Index is not available anywhere else in the public domain. Now note how the Nifty has logged 1.20% gains last week, but the LWTD reading has come down from 0.20 to 0.15, which tells you that support will come because the LWTD remains above zero, so support will come. But support compared to the prior week may just be a little mild, maybe a little tepid. Can things change? Yes, of course, things can change because this chart is weekly. On my social media accounts, particularly my Telegram channel where most of our research is shared, I share the daily chart of the LWTD. So do connect with me there. But as things stand, as I record this video on a Saturday, the LWTD reading, is mildly lower. So support will come, but somewhat tepid. Our in-house indicators done. I now come to the bond market. Do remember, we have been taking a lead as compared to the broader markets about including bonds in our analysis because the bond market funds all the other asset classes. And last week, what we saw is a noticeable decline in the 10-year Indian benchmark bond yields from 7.16% to 7.08%. And now what we are seeing on the weekly chart is a close below the support trend line. And like I told you last week, I'm doing nothing in the fixed income market. I'm sitting on my checkbooks because neither is the round number of 7.0 being violated, nor is the bond yield going above 7.5, 7.6, where I would start laddering. So I'm still sitting on my decision to go for gilt funds, which I will once bond yields basically start falling very, very sharply. So early days yet. Do remember the RBI Monetary Policy Committee meeting is to meet in the first week of August, and then they will determine interest rates. We'll take a call as and when the time is ripe. Friends, the bond market's done. I now come to the bank Nifty, which lost a little under 0.25%. Now, the daily chart on your screen tells you that the index fell on 3 out of 5 trading sessions. Friday was a decisive day due to a bullish hammer which was made, and this was done very close to the rising month-long moving average, which is a short-term support. And as long as the price is above the month-long moving average, the immediate short-term outlook remains positive. Do note the 44,152 level is the near-term support and the previous swing high. As long as the bulls maintain the bank Nifty above this level, the possibility of further upsides cannot be ruled out. And we need the bank Nifty to rise if the Nifty is to hit 20,000. This is a prerequisite. Now let's move to the weekly chart. What we are seeing is last week I had indicated a shooting star, inverted hammer, which is known as Nagareboshi candlestick formation in Japanese candlestick analysis. Now, I told you that would act as a resistance. And if follow-up buying does not come, the coming week could be a little bearish, which is exactly what happened. Now, the high of the Nagareboshi shooting star is 45,655. Which means the bulls will have to take the bank Nifty spot above 45,655 on a closing basis to trigger a fresh up move. The price remains above the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook remains optimistic. Here again, the 44,152 level is an immediate support that I am watching. Friends, in the week before last, this index was number 2 on the most volatile counters list that we maintain in-house based on statistical beta. It fell 2 notches to number 4. It's not that the volatility on this index has come down necessarily. It's just that volatility of individual stock options and futures has gone up a little faster than the bank Nifty. So challenge level remains. Last week, I advocated an estimated range between 46,050 on the upside and 43,800 on the downside, which held perfectly well. In the coming week, I estimate ranges between 45,900 on the upside and 43,725 on the downside. This index will determine whether the Nifty will go to 20,000 or not. And it's appearing slightly sluggish. So let's be careful out there and trade the bank Nifty a little light. Friends, I now come to the Nifty 50, which led the rally from the front, gained 1.20% and rose on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. Wednesday was the only losing day last week. The price remains comfortably above its month-long moving average, which means the short-term outlook is remaining positive. The chart is relatively stronger than the bank Nifty and it's going up in a straight line, sort of. 18,887 level is the previous swing high support. Way down. A little under 700 points lower than where we are right now, but that's where the support is coming in. Let's take a look at the weekly chart. What you are seeing is the prior week had a Nagareboshi or the shooting star formation, which was overcome on the upside. Unlike the bank Nifty, the Nifty has actually overcome the resistance of the shooting star or the Nagareboshi, which means, relatively speaking, the Nifty 50 is stronger than the Bank Nifty. Now, if the Bank Nifty does not drag the Nifty, I would say that the coming week could see a good possibility of 20,000 being scaled. The price is above its 25-week exponential moving average, which means the 6-month holding on cost of an average bull is far lower and they are comfortable holding on to it. And the medium-term outlook is also positive for now. In the week before last, this index was number 7 on the most volatile counters list based on statistical beta that we maintain in-house. It rose 4 notches to number 3. Now this is somewhat of a concern. Volatility on the Nifty has gone up sharply. So challenges to a retail trader have also grown. We need to take this carefully. Last week, I advocated a range between 19,725 on the upside and 18,950 on the downside, which held perfectly well in spite of all that volatility. In the coming week, the estimated range is between 19,950, 950, which is a tad under 20,000. So, which means it can be scaled on the upside and 19,175 on the downside. Here again, volatility is high, so let's be a little careful out there. Friends, I now come to the last bit of statistical analysis wherein I track the retail risk appetite by way of the turnover that they contributed in the 4 derivative sub-segments of the market. Now, what you are seeing on your chart is the index futures, which are denoted by a blue line, saw a stagnant percentage contribution in turnover, as did the stock futures, which is denoted by a red line. So these two relatively high risk segments saw unchanged turnover. The absolute low risk segment of the market, which is the index options turnover, saw a decisive decline in the turnover contribution, and the matching turnover increase was seen in stock options. So there was a mild increase in retail risk appetite, but the reason why I say it is mild is because it is in the option space, not in the futures space. Futures demand a higher degree of span margin and mark-to-market payouts, and therefore higher conviction. So there was buying, there was a little bit of risk taking, but in the option segment. In the coming week, I would want futures segment to contribute higher turnover, especially in stocks, before we can say that the Nifty will hit 20,000 conclusively. Friends, I now come to what my trading blueprint will be in the coming week. I will seek opportunities in public sector banks in either direction, depending on which way the snap quote window or the best 5 buyers and best 5 sellers, the snap quote window is telling me. Chemical company stocks may see a derating, which means a little bit of a downside due to global concerns. Now, the other concern that I noticed was the largest bank in India, State Bank of India, has started raising lending rates, albeit by 5 basis points, but cost of funds has been going up. Now, this is a concern that I have been sharing with you on my social media accounts, particularly our Telegram channel, on which I have very detailed analysis put out for free. Please make it a point to subscribe to our free Telegram channel. So cost of funds is rising, and if other banks also follow suit by raising lending prices, lending rates, then there could be fresh pressure on equities. Coming to the commodity space, I see expiry related pull and push on crude oil, which will expire first, and then in natural gas, because natural gas expires a week later. But as I mentioned in my recent special video on the outlook on natural gas and crude oil and the impact on equities, please make it a point to watch that video. The hyperlink is in the description below and in the pinned comment below this video. In that video, I said the rallies are short-term in nature and more due to seasonal factors than anything else. coupled with deliberate output cuts by producers in the oil market and in the crude oil market. It is a lot of speculative in the natural gas market. I'm sorry, it is more speculative frenzy. Because the Dixie, the US dollar index, is below the 100 mark, the weakness in the dollar will see some short covering in metal prices, which means industrial metals might see a cushioned decline, if at all there is a decline, because the dollar is the invoicing currency. Silver saw a spectacular 6.5% rise last week, and although the larger, longer term outlook remains positive, you could see a mild slowing down in the momentum upwards. And what we are likely to see is some amount of deleveraging, which means lower risk appetite from traders who might reduce exposure overall. Friends, I now come to the most popular segment of the market for the statistically minded traders from my online family, wherein I give you 5 stocks that gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks which lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. This is for scalpers. The list is valid only for Monday. Tuesday through Friday, I update it on our Telegram channel for free. Remember, this is just the names. Direction will be decided by the snap quote window. So the high beta or high impetus stock list is led by Delta Corp, followed by Polycab, Ashok Leyland, Naukri, and Balrampur Chini. The impetus losers list is led by Power Finance Corporation, State Bank of India, ITC, HDFC AMC, and IDFC. Friends, I hope you enjoyed this video and I have answered your question about whether the Nifty will reach 20,000 in the week ahead or not. To sum it up, much will depend on banking stocks, which constitute 1/3 of the weightage in the Nifty itself. So you can't have one index going up and the other index coming down. For the Nifty to scale 20,000, both need to go up. It's as simple as that. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know how our work is helping you become better traders. Also, help me reach out to a larger target audience by sharing this video with your friends, family, and social media groups and fellow smart investors and traders like yourselves. I thank you for your patience, for staying with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.